everyone, and welcome back to this week's Money and Market Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global markets for this week and beyond. Today is Tuesday, March 8th. I'm Mike Bernick, and joining me today are Larry Edelson, Kathy Lean, Boris Schlossberg, Mandeep Rai, and David Dukevich. Well, we've had a pretty good rally here over the last couple of weeks in the market after a near bear market experience there that we had to start off the year. We've seen the S&P 500 actually put in quite a nice rally over the last couple of weeks, up about 7 or 8% from the lows that we saw in early February. Actually, a little bit more than that after yesterday, about 10% rally. So I guess that begs the question: is this just a bounce? Is the bottom in? Was that it in terms of the correction, or is this the mother of all bear market traps is getting ready to be sprung on investors? Larry Edelson, let's get your take first.
Well, I don't think it's the mother of all bear market traps, but I do think it is a bear market trap. We're not finished on the downside yet. Cyclically and technically, we have not met the objectives on the downside yet. We haven't broken through any really major resistance levels. On the upside, we're still capped by 17.5 and 18.5. And the timing isn't right for it, to take off into the second leg of its bull market. I am very bullish long term, as everybody knows, but timing is everything, and I don't think we're there just yet. I think we're probably going to be trading lower into late May, early June, then slightly higher into the elections, and then 2017 is when we're really going to take off to the upside. And fundamentally, if you want an explanation, it'll be because the world wakes up and finds out that we have one of two idiots running the White House, either Hillary or Donald Trump. And everybody's going to want to be out of anything to do with government and into the private sector, good quality, blue chip, big cap type stocks, anything that has nothing to do with the government. They may depend on the government to some extent for contracts, but basically, that's what we're seeing, a backlash against government. That's what Donald Trump is all about, and that's why he's so popular. And that's your telltale signs that the sovereign debt crisis and sovereign rebellion that I've been talking about for the last 2 years is really taking shape. It's taking shape all over the world. There's protests and rebellions against the establishment everywhere. And, the first inkling of it in the United States is the popularity of Donald Trump. So that said, I don't think the downside is done yet in the stock market. We should see a move lower into the summer before the long-term bull market comes back. Gold, I'm showing a top today or tomorrow. We did move a little bit higher. We caught a little bit of it for SCT, but gold should be topping now and moving lower into May, retracing its first leg up. Same for silver. Oil's moving really nicely in accordance with my forecast, up to almost 38. We should get up to 42 over the next few weeks. So I'm starting to pick up some nice gains for my numbers in the oil area. Got a ways to go, but we have some gains in the UWTI, and some of the options are coming back into play as well. Euro biding its time before it just collapses again. That's all it's doing. Same with the dollar. And that's really all I have.
All right, thanks, Larry. Appreciate it. Boris Schlossberg, how about your insights? I know that you're a little bearish on the euro here as well.
Yeah, I think the euro is just biding its time in front of the ECB. Ultimately, we think it goes to about 105, possibly even parity end of the year. It's one of our bigger calls for the year. But in the meantime, I think what's interesting is that we're starting to see consistent deterioration of economic data out of China that is just not being fully appreciated by the market. Chinese trade data came out today, and it was like literally half of what it was expected to be, and exports were down by 25%. But the market completely shrugged off the whole data set because of Chinese New Year, because of seasonal adjustments. But this is the second month in a row where the Chinese are just not selling enough goods, and that tells me, I think, that the whole economy in China is perilously close to a much more serious contraction than everybody thinks it is. And that leads me to think that actually equities and everything else, I've been saying equities are a sell the rally trade. all year long, and so any bounce in equities right now is going to be an opportunity to sell, because I think we're going to see a lot more turbulence as we go forward, especially into the summer months.
Interesting. Kathy Lean, anything to add?
Yes, I just want to talk briefly about where we think the turbulence can come from. And I think that the large part of the rally we've seen over the past month or so, or 6 weeks, has been driven by just paired expectations for the Federal Reserve raising interest rates. I think the market took its time to discount the fact that nothing's going to happen in March, and I think everyone agrees that that's the most likely scenario. But now we're starting to hear Federal Reserve officials confirm to us that, first of all, another rate hike in 2016, regardless whether it happens or not, it's still on the table. And when they meet in March, their guidance could remain quite hawkish. I mean, the person I'm speaking specifically about is Vice Chair Fisher, and everyone knows that when it comes to Fed policy, most of the decisions are made by the top three. So Vice Chair Fisher is one of them, and yesterday he said that he's seen the first possible signs of inflation. He also said that the U.S. unemployment or labor market is close to full employment. So all of that combines with the fact that oil prices are bottoming, so it's no longer providing such significant downside pressure to inflation. And also the general data that we've had from the U.S., I think, is enough for Yellen to not back away from raising interest rates at all again in 2016. So what I think is going to happen, and that plays into what Boris and Larry said, is, first of all, we obviously have this very nice stock market rally. But once we go past the FOMC meeting and Federal Reserve officials tell us that another rate hike is still on the table, you may actually see an adjustment as a result of that. Stocks fall, dollar rise. This is not to say that they will go through with it or they can go through with it, but I think that could bring the disruption to the markets in the next month or two.
Interesting. Thanks for those insights. Good stuff. Mandeep Rai, what's your take in the markets?
Hey, good morning. Good morning, everybody. So, yeah, we've seen a pretty impressive bounce back of the markets, and the only true catalyst that I can kind of point to was that we did have better than expected economic data. And like as mentioned already, the expectation of more QE from central banks, ECB meeting next week, Thursday. All they're really doing is sinking more into debt, reflating economies, weakening currencies, and hoping that growth will return to allow them to deleverage. So that's the theme that's kind of playing out. We've come back, like you said, Mike, 10% in the S&P. The earnings fundamentals for corporates here in the U.S., the picture is still actually looking quite grim for the first quarter. Expectations now are for an 8% decline, and that's following the previous quarter. Now we've got about 99% of companies reported. It was a 7.5% earnings decline. Prior to that, the third quarter of 2015, we had a 4% decline. So that we're actually accelerating to the downside. So this is the lower commodity prices. This is the energy drop, the materials sector that's been weak. So the stronger dollar, global growth that's been weaker. It's also hit industrials, and it's cycling through company fundamentals as we speak, and it's kind of playing itself out continually. I mean, it's not like the market is rallying and it's getting a fair value. We're at 16.1 times forward earnings. But if that E in the PE continues to decline, even at a current level, the market's getting even pricier. So that kind of points to the potential for even more volatility. And as for the ever important guidance coming out of companies that do give that kind of outlook, 91 companies issued negative guidance versus 24 companies that had been positive. So overall, the weakness in the earnings perspective is still very much in play. We've already talked about China. The trade data was absolutely disappointing, and they were the leader of this global economic growth engine. So where is that going to come from? And China is actually going to be faced with excess capacity, and the plants and the factories that these provinces built out could become redundant, and we could see more and more layoffs there. and even hampering that further, that growth as it tries to transition to a consumer-led economy. So that's kind of problematic for the rest of the world, and it's probably why the futures were off so hard this morning, but kind of shrugging it off again as we get closer to the open. As for oil, Larry had spoken about that already. It's been pretty strong. The gamesmanship is going to continue. There's a tentative freeze in place. Saudi Arabia, Qatar, Venezuela, Russia talking about the freeze, and other countries are more worried about the sincerity of following through on the production freeze, and they don't want to lose market share. This morning we heard from Kuwait, said that they're still going to continue to produce. So that's globally. On the U.S. side, we've had a small drop in production, so we're slightly over 9 million barrels per day as of the EIA report last week, even though we had a huge build at Cushing, and that kind of saw oil kind of continue its rally higher, and I think we could have probably getting to a point where we're at a significant amount of resistance. I had said last week, EOG Resources on their conference call, their earnings call, said that at $40, they're going to turn the pumps back on. They're going to be drilling in those wells again, earning 30% rates of return, and that's kind of that's kind of detriment to the situation. Is that we have the best technologies, the best finding and drilling technologies around the world. And when these allow our companies to extract more oil for longer periods of time, but it adds to that supply glut. And even though oil has rallied, we're still at the largest stockpile of inventory that we've seen in the U.S. for 80 years, and that's even coming as rig counts drop to 2002 levels. So we're going to be testing that resistance now. I think from here to 40 is where I start to fade the rally. I want to step back and reassess and let it do its thing. Oil is very, very volatile. We could still see another drop back. But like I said, I'm going to be taking some money off the table here. As for the dollar, it's already been spoken about. I think the divergent policies augur that dollar continues to rally. The inflation risks are actually stepping up here in the U.S., and I think that the potential for rate increases are there very much so in the U.S. compared to worse economic data in Europe. Deflation potential there. Inflation targets are not being hit there, coming in disappointing. There's going to be more QE coming. Draghi has hinted. No, actually, not. He's indicated that there's going to be more QE. So there's a potential for some miss there on the expectations, but they're still trying to slog through a slowing economy and fears of deflation. But the fact that we've had better economic data here in the U.S. has kind of helped ease fears of a recession, and you've started to see investors kind of dip back into those investments that they sold on those fears. And you got short covering, and we've got a nice rally, but I think we're at a critical support resistance level, whatever you want to call it. We're at a level where it's pretty critical, and it's not just in the S&P. It's also in the high yield. It's also in oil. It's also in dollar. So, outside of more QE, out of ECB and the Fed meet next week, I don't necessarily see what drivers would be able to get this market much higher after this rally. From an earnings perspective, we're actually getting pricier as the E goes down. So if we did get a QE rally courtesy of the ECB, I'd be looking to fade that as well and wait for an opportunity to kind of buy in weakness. I don't think the volatility is over, but I do want to pick spots and be patient and be opportunistic when I get the opportunity.
Absolutely. This market has definitely been all about being opportunistic with the volatility we've seen. Thanks, Mandeep. Appreciate it.
You got it.
Let's see. David Dukevich, you get the last word for today. What's your take on markets?
Oh, hey, Mike. Hi, everyone. Well, I do think, we have come into that critical resistance level, as Mandeep just mentioned, right around the 2,000 level on the S&P 500. With the rally we had starting from that double bottom that we kind of saw around that 1812, 1810 area, this rally could push a little farther still. Maybe we get to somewhere in the 2020 to 2045 range. On the absolute high side, I think we could possibly go up to 2085. But at this point, it's not time to get long. I don't think there's much more room to the upside if we do get it, and I don't think it'll last. I do think it's time that you either want to start going long volatility or starting to cut your long positions or actually getting short the markets at this point, because I do think we are going to start to test the downside again. How far down we go, that's still the question. I think we'll definitely try to go back and test the old resistance level at 1950, which will be a major support level. If we break that, then obviously, we're going to get back down to the 1900 level and going back down to that 1820 to 1812 level potentially. So I do think we're at a critical point here. Definitely not time to start adding long positions. But, certainly we could still see, especially with some ECB or Fed talk, that actually may be able to push the markets a little higher, but I don't think it's something that we'll see last at this point. We've seen gold rally really strongly here. It started with a lot of short covering. It's still been kind of pushing higher, but it does look like it's stalling out here at around that 1275 level. Again, it could go a little higher. Maybe we see 1300 in the cards, but I do expect a pullback, and I'd expect to see a pullback at least to that 1200 to 1188 level. Natural gas actually last week kind of hit a new low. It broke that December low, but it does seem to be firming up a little bit again here. So if we can get some momentum, we might be able to see nat gas catch a rally here. That's one of the markets that actually hasn't been rallying with everything else. But I do think we could see that actually start to make a move and maybe get back to the $190, $2 level. Oil itself is still sitting at a critical point around that 37, 38 level. I do think we might want to, the market's going to want to test the $40 level. If we can get through there, we'll get some further upside. But again, I think maybe that'll be a stalling point with its pretty significant resistance there, and maybe we'll pull back a little bit. But I do expect to see oil continue its move higher, even with a small short-term pullback.
Okay, thanks, David. Well, that wraps things up for this week's Squawk Call. Great insights, ladies and gentlemen. Thank you, one and all. And be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.